Welcome, everybody, to the Q1 2026 recorded dialogue that goes along with our accompanying market note, which you have received in electronic format, the written market note that we send out periodically to you to talk about capital markets and financial planning topics. And so this is the January 2026 version of that. So the topics we will talk about today will track with the written newsletter that you are receiving there via email. And so with that, we will proceed. Just a few preliminary slides to reintroduce you to the firm, Wealth Enhancement. We are the Integra Team at Wealth Enhancement. Very large firm now. We're now ranked number 7 among Barron's top 100 RIA firms. And you can see some of the other things going on here. Agenda for today is I'll kick things off talking a little bit about the equity markets in the rearview mirror and also going forward, some macroeconomic information to kind of set the stage. Alex will jump in and discuss equity markets with me as well. My partner, Tom Brighter, will then proceed to discuss the fixed income markets. And then finally, Andrew Gibson will discuss a particular financial planning topic, which is not the Social Security decision. That was the topic of the last recording we did, which did not get changed. He's going to be talking about the Senior Deduction Stack. So apologies for that. And these are pictures of today's presenters, but you can see our faces live today. So, okay, you'll note the first topic that we talked about in the newsletter was under the caption 2025 was all about artificial intelligence, and 2026 will be about more. So what are we talking about there? So so far this year, which is really just the month of January at this point, so not a long representative time period, but a lot has changed. Equity market participation has really broadened out for the month of January. This chart that you're looking at here is as of January 23rd, not to date yesterday or today. And what we're comparing here is the purple line is the S&P 500 equal weight index, which is up about 4.26%. And then the S&P 500 total return market cap weight index, which is up 1.06%. It is the S&P 500 market cap weight index, the orange line, that is the most widely published equity index. And maybe it shouldn't be because it's very heavily weighted to US large cap technology stocks. So as we alluded to in the title of this section of the market note, companies in these exponential growth phases, especially large cap tech, have been underperforming in the month of January as compared to companies that really didn't attract as much investor attention last year. And this year pose better valuations, I think, for investors. And so the market has been broadening out, which is by and large a positive sign, despite the selling that has occurred yesterday and today a little bit. So part of this is valuation driven. Part of it is likely profit taking. A lot of people are probably way up on some of these very high growth flyers. And now that the 2025 tax year is closed, there may be some repositioning and some gain harvesting and locking in going on, or maybe just some rebalancing. So market structure is probably at play as well. And you obviously see this as evidence right here in front of our faces, right? So the equal weight S&P is all 500 of the largest US-based companies, equal weighted in the index. So, and I think this paints a pretty good picture of what's transpired so far in January. If we dig down a little bit deeper under the surface of the index and just look at a few large cap tech names, I think this tells the story also. Again, as of January 23rd, before some of the earnings reports yesterday, Apple, Microsoft, Netflix, and even NVIDIA negative on the year so far, whereas other names, as the market has broadened out, are quite positive. The exception here is Alphabet or Google. which has a really broadly diversified business beyond search and so forth that involves AI and all sorts of underlying businesses. And that has been the one exception to large cap tech. And if you followed along yesterday, Microsoft reported earnings that were pretty good, actually, but talked about some big capital expenditures that are coming up and failed to mention anything about corresponding increases in sales with those expenditures, and therefore it was punished because of that yesterday. So that Microsoft's actually down even more after yesterday's market close. But you can kind of see this pattern here. Whereas Meta, which is the old Facebook, actually surprised to the upside yesterday, and it seems like all their AI spending is actually working to drive revenue growth, and so they were rewarded for that. And that's kind of the story and the pattern among these companies. These are all still very strong businesses. They were just got to the point where they were priced for perfection. And so this is really sort of a natural ebb and flow of markets as we've seen. So let's take a little sector view of valuations. The chart you're looking at here is forward 12-month price to earnings ratios, just comparing the information technology sector as a whole on a forward price to earnings multiple basis versus two more attractively priced sectors coming into the year, which was consumer staples and healthcare, which did not participate as much last year, of course, as we've been pointing out. So I think the exception in healthcare, and this is kind of part of the working through the new administration we've had for a little over a year now, is that things can change really quickly. And this week, the administration announced that they were trying to impose ceilings on prices of certain medical services and so forth, which really hit the health insurance stocks hard, really hard. And so, within healthcare, there are good examples and bad examples. So moving outside domestic US markets, let's talk a little bit about international equity markets so far. Actually, Europe, which is the purple line, and emerging markets, which is the orange line. This is a chart year to date as of January 23rd, but both of these positions actually performed well last year as well and have continued into this year. So we're seeing some outperformance in international equity markets relative to US markets, again, probably because the baseline pricing was more attractive than what was being found in the United States. Also, they had currency fluctuation and the devalue of the dollar as a tailwind to performance as well. So multiple things going on there. I think out of the two of these, we probably prefer emerging market equity on a go-forward basis for several reasons. Not the least of which is expected forward return based on current pricing versus the risk. The lower the starting price, the less the risk. It's a favorable setup. We also like the fact that a lot of emerging market economies are primarily based in natural resources, and that's a big part of their economy, or commodity prices, if you will. So instead of just counting on the spot price of commodities, we like emerging markets to mix in that commodity exposure as well. So what about the Eurozone? So as I mentioned before, the Eurozone performed quite well last year, but what about on a go-forward basis? We've become a little bit more bearish on the Eurozone equity market for this reason I'm trying to depict in this chart here. This chart is of the manufacturing PMIs, or manufacturing activity for the Eurozone as a whole, which is the green line, and then Germany in particular, which is the largest Eurozone economy. And that red dotted line, which is the 50 line, that defines the expansion threshold. So when the line is above that economy is in a manufacturing expansionary phase, and when the line is below that dotted red line, it's in a contractionary phase in terms of its manufacturing sector. So as you can see, Germany is deeply in contraction phase, which is a problem, and so dragging the rest of the Eurozone down as well, which is the orange line. So for that reason, we're becoming a little less bullish on European equity. So that's kind of the landscape in international equity, kind of drilling down a little bit more specifically into countries in the emerging market realm. Probably the most important and biggest economies there are, as you see, these green bars: India, Vietnam, Indonesia, China, and Malaysia. And those are all the PMI, manufacturing PMI readings are currently all in expansionary territory. To a lesser degree, Turkey, Poland, Brazil, Mexico, South Africa, these are smaller economies versus the green bars. So this paints a little bit brighter picture for emerging market equity at this point. Okay, so that really kind of gives you some information on domestic equity markets, international equity markets, what we're thinking, how we're investing. Within the broader equity market, the hot topic, of course, is artificial intelligence. And so we wanted to spotlight that a little bit. And Alex Galt is going to talk to you a little bit about what's going on in the AI realm.
Thanks, Brad, and thanks for the frame in there in context. And it's becoming a little bit of a theme that everything I talk about on these is AI. So I'll have to get a little bit more creative next time, but we'll talk about that offline here. So a couple interesting kind of factoids in this chart here, as Brad alluded to in the beginning of the market note. We're starting to see the market broaden out, and we see that with the S&P equal weight. We see that in other sectors. And I think there's a couple reasons for that. Number one is valuations broadly in the Mag 7 and tech are just super elevated, and eventually those sort of go back to what we call the mean reversion, and averages kind of reset. The other thing here, which is interesting, is that AI, or the way I look at it, is productivity efficiencies are being enacted in areas other than just technology and finance companies. And we can see here, on average, about 17% of all firms are reporting using some sort of AI. And of course, technology companies and finance and real estate and things like that are at the top of the mix here. But some of these in the bottom are starting to become more meaningful contributors. And I don't think it takes a lot of implementation for those to move the needle in terms of profitability and make them more efficient. And so I think that's part of what we're seeing as well. The chart on the left-hand side just kind of categorizes each company by their current AI adoption versus their next 6 months AI adoption as well. That doesn't come without risks, right? If you know anything about investing and return on equity or return on investments, investments are not equal among companies, right? So if that company does not have a historical track record of investing profitably in technologies or new things, and that can be a little bit of a concern, of course, and something you have to look at. But I think the big picture here is that even traditionally slower moving sectors are starting to participate, which suggests that AI is really moving from more experimental to real operational use. What the impacts will be, we'll see how that all plays out. Another thing I'll note here, which is not necessarily on this chart, just talks about the labor market. Some of the concerns we're seeing in the labor market, which companies being in that sort of no hire, no fire type of atmosphere. And we have actually seen some layoffs in certain parts of companies, but specifically, they're not hiring as many administrative support folks and things like that, which were typically needed. And I think that has a lot to do with AI. I'm a big reader and like to read not only our market note, but others. And Rick Reeder, who's the chief investment officer of BlackRock, puts out sort of a quarterly piece. He's the chief fixed income officer of BlackRock, puts out a quarterly piece. And he talked about some of these implications of the labor market. And just to give you some high level figures, labor broadly represents around 55% of total business sector costs. And if, let's say, that went from 55 to 50, so about a 5% decrease in labor costs, that would create around $1.2 trillion in annual labor cost savings. Now, we can get into, what happens to those jobs and the repositioning of the job market. But from profitability perspective, that is a lot of what we're seeing in the market here. It does not take a significant reduction in labor costs to see a meaningful increase to profitability. So, of course, there are some pros and cons to that. We have some regulatory, political, social pressures that could sort of slow adoption or limit how aggressively companies pursue labor savings. But I think the math is the math, and certainly is important to consider. And so, that's really what I wanted to cover today. And I'll let Brad move a little bit deeper into the labor market, the economy, and some of the economic factors that we're considering here.
Hey, thanks, Alice. Alex, perfect segue. Perfect segue into the other article that we had written in the market note, which was called a bifurcated 50/50 economy. And that's exactly what we were talking about. I brought up the U.S. unemployment rate slide for Alex when he was speaking. And that's exactly right. The unemployment rate, if you look at November 2025, that peak there in the purple line hit a pretty big number above average, but by no means, recessionary levels, and then has come down since in December a little bit. Two dynamics there, I think, as part of it is what Alex is saying is no hire, no fire because of artificial intelligence, increasing labor productivity, needing less employees, and so forth. We're also hearing that companies like Amazon and UPS, for example, and it depends on the business that they're in, have been laying people off and continue to lay people off because they overhired during the pandemic years, and that is still unwinding, which I did not realize so many years later now, but that is still unwinding. So it's seldom one dynamic, right? It's always, multiple things happening at the same time that impacts the labor market. But that's kind of what we mean by a bifurcated economy, because if we just look at gross domestic product, and this is the Atlanta Fed GDP Now estimates for the fourth quarter of 2025. So GDP Now is a higher frequency set of data. So it's not as rear view mirror. It's more real time numbers, but they are forecasts. They are not actual data. So if you look below in this black box that I highlighted, the maximum forecast of real GDP growth in the United States is 5.4%, and the minimum forecast of real GDP growth is 2.7%. So 5.4 is a really big number. We haven't seen that in a developed economy like the United States in quite some time. So if we're just looking at this chart, we think everything's really good economically, and it may very well be. But on the other hand, when we look at the unemployment rate, we see a bit of a different picture. And both of these dynamics, I'm sure, went into the Fed decision yesterday to remain steady with rates and not reduce again, although they probably will in the future. So, Alex, that was a great segue into this. So the question is those two green dotted arrows, which direction is GDP going in next, right? Because it's nice that companies are picking up profit margin, as Alex was stating, by reducing the labor cost, which clearly they're doing. On the other hand, if those people don't find other employment, consumer spending is 70%, almost 70% of the U.S. economy, and that could put a dent then in economic conditions and transactions. So something to keep an eye on, but that kind of paints the picture of what we mean by the bifurcated 50/50 economy. So one other thing to point out on the economy, interestingly, uh, uh, Alex we try to follow different economists and different market strategists. I'm often caught quoting Brian Westbury, the chief economist at First Trust Portfolios, who's been more wrong than right over the years, but nobody's right all the time. Um, he kind of laid out a bull and a bear case on a go forward. His bull case kind of consists of a better tax environment, deregulation, less wasteful government spending, potential rate cuts, further rate cuts, perhaps a lower inflation rate, although it has ticked up a little bit recently, and of course the AI boom. And then on the bear side, the money supply isn't up quite enough to support the forecast GDP numbers, given the rate of inflation. We're seeing an increase in buy now, pay later transactions with providers like Affirm and so forth, which can be good or bad depending upon if how repayments are made. Auto lenders have reported that they're stretching payment terms. There are other loan delinquencies that are on the rise, not at dangerous levels, but rising a little bit. And the moratorium on student loan collections has been lifted, and those will begin again in February. I believe it's February, maybe January. And if the employment picture was to worsen, as we just talked about. So again, very consistent with this sort of bifurcated 50-50, chances of which way we're going with the economy. So that's the investing environment. With that, Tom's going to talk to us a little bit about the fixed income market and give us a little overview of that. Tom?
Yeah, thanks, Brad. Welcome, everybody. Greetings from Jackson Hole, Wyoming. I'm on due diligence meetings out here. Yeah, Brad, in the newsletter, Brad did a great job of describing, the way fixed income markets work. Rates go up, bond prices fall, and vice versa. I think it's important to talk about the current climate. As an aside, there's no shortage of media coverage about the pressure from the administration for wanting lower interest rates, for the Fed to lower what they can control, and they can control short-term interest rates. Earlier this week, before we recorded this, there was a Fed meeting, and they voted 10-2 to stand pat or make no change to the federal funds short-term interest rate. I think it's important to note that even if the president had been able to get one more additional person of his that was inclined to vote for lower rates, it would have been a 9-3 vote. So it's not the Fed chairman that makes this decision. It is a committee that votes, and it's a majority vote that determines what's going to happen. So the other thing I'd like to add is, and we've talked about this before, just because you lower short-term rates doesn't necessarily mean that long-term interest rates are going to come down commensurate. And the longer term rates are the ones that really impact the consumer more. So if you're getting a home mortgage, that home mortgage is calculated and tied to the 10-year treasury, currently yielding around 4.2, 4.25%. That's below the really long-term average. Now, compared to a few years ago, 4% is very high because the 10-year treasury at one point got down to around 1% 5 years ago. However, if we look at a little bit more of history, interest rates are pretty normal right now. We've got a normal 10-year yield. We've got a normal federal funds rate. And we also expect the Fed to cut rates maybe one more time in 2026. However, inflation remains a little bit elevated above their target. So I don't think it's a slam dunk that we get a bunch of interest rate reductions. That's my personal view. And Brad, that's pretty much all I had to add.
You're on mute, Brad.
Sorry about that. Thank you, Tom. Forgot to unmute myself. Thank you for that. Yeah, fixed income markets are all about rates and all about potential defaults, right? So important to understand all that. Andrew, you're up. The
Yes.
financial planning topic for the newsletter, the Senior Deduction Stack.
The most fun part of this presentation. I'm just kidding. You guys did a great job, and it's good. I think clients will take some comfort in knowing that we're thinking about all the stuff in the investment world. So I think this year's theme is probably going to be the One Big Beautiful Bill Act. A lot of people are trying to figure out exactly how can they take advantage of tax cuts. Weren't really cuts, but they stayed the same. But what are some of the ways that we can reduce tax? So there's been a lot of noise about Social Security not being taxed anymore. It's not necessarily correct. So what they did is they're actually giving a senior bonus deduction on top of your standard deduction. So if you look at the bar chart on the right side that's stacked, everybody gets a standard deduction. If you're single, filing single, it's around 16,000, and if you're married filing jointly, it's 32,000. If you are 65 or above 65, there's a traditional additional deduction, which you can see there for single and qualifying spouses. The new part of the One Big Beautiful Bill Act is the senior bonus deduction, which is 6,000 per person. So you can see you can actually stack all of these deductions. So if you are single filing, you're going to have about $24,000 of a deduction before your next income is taxed. And if you're married filing jointly, it's going to be 47,500 if you're above the age of 65. So again, it's stackable deductions, right? Not a whole lot of people have $47,000 worth of itemized deductions they can use anymore. This is available whether taxpayers itemize or not, meaning that they can still use the senior bonus deduction. And now this phases out at higher income levels, so it's around 75,000 for a single person, and it's about 6 cents per every dollar above 75,000 that it'll be reduced by, and it's 150,000 for married filing jointly. So again, what this does is it expands your federal tax-free income zone. So really, you could have no taxes on Social Security, right? But if we could go to the next slide here, I'll kind of give an example. Okay, so we have a couple married and they're both the age of 67, but they're delaying Social Security until 70. So they have retirement income. Their pension is 36,000. Their IRA withdrawals are 25,000, and the total income is 61,000. Now they have their deduction stack, their standard deduction of 32,200, their traditional age 65 deduction, which is 3,300, and then your senior bonus deduction, which is 12,000. So that gives you a total deduction of 47,500. If you look at that, that means you only have 13,500 exposed to taxes. So you have $47,500 until you start to get taxed. The reason that I didn't show a Social Security scenario on this is because Social Security, your base can be taxed up to 85% of what your income is, right? So if you're getting, if you have income, total income, and say that's around where the bracket would be, where you're only getting taxed up to 50% of that income in Social Security, you could very well not have any taxes at all from Social Security. So that's why we're not saying it's a total end all be all of taxes for Social Security. It depends on how much total income you have. And it also depends on what age you are and if you're filing single or jointly. So I hope that helps out a little bit, clear up any misconceptions about that.
That was great, Andrew. All important topics. Federal income taxes and taxes in general are the largest, usually the largest expenditure for anybody during their lifetime. So always an important topic in the financial realm. So that wraps up the presentation from the market note. You probably linked to this presentation from the delivery of that market note. So if you have any additional questions, please feel free to reach out to whoever you normally talk to on the team, and we'd be happy to answer any questions or concerns that you have. We appreciate you being clients with the Integra team at Wealth Enhancement. We appreciate that very much. We love the work we do, and we love working with you and your family, and we hope it has a positive impact in your life. And with that, have a wonderful weekend, and we'll see you next time.